time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
So Corus Entertainment, symbol CJR.B, which is their main share, it's their non-voting share, which is the ones you'll actually be able to purchase on the TSX exchange, is trading at $2.28 a share, and it is a Canadian broadcasting company. The company currently operates 33 specialty television channels, 15 conventional television stations, and 39 radio stations across the country, as well as producing television content that is broadcasted around the world. The company is profitable, having a profit of $29.6 million or 14 cents per share in Q3 2022. Revenue is dominated by the television segment, which brought in 93% of the $433 million in the last quarter. Television brought in $128 million in segment profit, while radio only brought in $6 million, showing the clear dependency in television on their television segment. The company does pay a dividend of 6 cents per share in the last quarter, bringing the trailing 12-month dividend yield to 10.4%. Seems great, right? Profitable, has nice dividend yield. The problem is the company is stagnant for growth. Making the lack of growth more concerning is the significant debt position of $1.27 billion in debt. The company isn't crushed by debt at all, though. It is still producing free cash flow that exceeds the interest and financing costs, which has allowed it to pay down its debt over the previous 5 or so years. Part of the reason why it has been able to pay off its debt, though, is it's lowered its dividends in 2018 from 9.5 cents to the current 6 cents, which it has stayed at since then. Which seeing dividends drop is always a bit of a concern, and why they are doing it. In this case, it was to start to pay off their debt. Of course, lowering dividends is better than ultimately going bankrupt. As the company is struggling to find any growth, the valuations reflect that. The trailing price to earnings ratio is only 3.3 times, and trailing price to free cash flow is only 2 times. Looking forward even, current analyst expectations are similar or lower for the fiscal year 2023 compared to the expectations for the fiscal year 2022. The price implies the broader market does not see a turnaround in growth anytime soon. But what is management trying to do to turn around? They are pushing content production. Some recent highlights include 200 additional hours of Canadian content, 45 green lights and renewals, and partnerships with Paramount Global to produce content and provide advertising representation for its Pluto TV streaming service, which is due to launch soon. So will we buy it? No. Even with the low valuations, it's hard to justify purchasing a company from a long-term perspective, as the growth is just not there. And the debt risk, although lower than previous years, is still considerable. If growth does appear, the company would be significantly more appealing. So I'll open it to the rest of you guys.